Hi everyone, welcome to our channel Accounts Builder. Here we are going to study about basic concepts of accountancy. But before we are going to study about the basic concepts of accountancy, first we have to learn about some terminologies which are important for accountancy. In accountancy, there are five terminologies which are also known as elements of accountancy, yeah, language of accountancy. So, to go through the accountancy, the financial statements, you have to make it rock solid. These five terminologies, these terms should be made rock solid in your mind so that you can be ready to prepare the financial statements. Okay, so those terms, those elements are also known as the language of accountancy. In mathematics, we know about certain complex equations like quadratic, simultaneous equation, trigonometry, geometry, etc., etc. The calculus, differentiation parts. But accountancy is not all about the calculation, it's all about the language, how people are talking about the revenue, how people are talking about the equity, how people are talking about the profit, how people are talking about the losses, etc. So these five terms are going to tell you about what accountancy is all about and how you are going to prepare the financial statements. So I am talking about these five terms. These five terms. So what are these five terms? These five terms are asset, liabilities, equities, revenue, and expenses. So before coming to the financial statement or before preparing the financial statement, we have to learn, we have to know what these five terms are. And when you are done with this, you are ready to prepare your financial statement. You are ready to go through your financial statement. I'm very confident that after this class, after this session, you are going to be able to make these asset, liabilities, equity, revenue, expenses rock solid in your mind. So before wasting time or without talking further, let's start with what accountancy is. So what is accounting? In day-to-day life, we normally purchases or pay some money to here and there. We pay some money, we receive some money. So in day-to-day life, we go to buy t-shirts, we go to buy sneakers. There we pay money, we buy some miscellaneous item from the general stores. There we pay money, and sometimes we withdraw cash from the ATM. That's there we receive some money. If we have lended some money to others, we receive back that. Here we receive. So these paying and receiving of money, these paying and receiving of monies are known as transactions. So this is known as transactions in accountancy. So if we talk about that, about today's transaction, you are going to remember, you are going to memorize what transactions you have done, where you have paid money and from where you have received money. If I talk about yesterday, you can recall that. If I talk about day before, is yesterday, some of you can, some of you can't. If I talk about a 1 month before, what you have received, where you have paid money, or if I talk about certain precise date, say on 16th of May, where have you paid money, or on 25th of January, from where you have received money, then you will be blank. You are not able to memorize, you are not able to give answer quickly. So to come up with these problems, we have a solution. This solution is known as accountancy, where we record our transactions. If you visit some pharmacy, some general store, there you can see, while giving you the medicines, the one person there writes, maintain a register what medicine he has given or she has given to you, and what is the amount he or she has received from you. This is a very basic culture, you all have observed this. So this is nothing but this is accountancy. This is about an individual, this is about one small store. But what about the big companies which are going through a lots of transactions, or thousands of transactions, or lakhs of transactions daily, on monthly basis, on yearly basis? What about them? How you are going to memorize them? How you are going to recall them? So this is this is the solution, this is the solution of that problem, that is accounting. So in accounting, we come up with, we summarizes our financial data in a meaningful format. This is nothing like if you purchase a medicine from a medical store, he will write some other medicine name, and somewhere else he is going to write what amount he has received. No, 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 no. When you summarize this financial data, this transaction in a meaningful format, this is known as accountancy. Accountancy is nothing but accountancy is the summarization of your daily, your day to day, your operating transactions, your financial data in a meaningful format. This is known as accountancy. To further add up within the theory, accountancy is the systematic process of recording, of classifying, and summarizing the financial transactions, where you come up with accurate information which are going to be helpful in further decision making and compliances. So accountancy is nothing but it is the recording, classifying, and summarizing of your transactions, so that you can come up with which can help you with your decision making. So this is accounting is all about. So now you know what accounting is. Now, to move further, let's go. What is accounting process? So we know what accounting is, but for accounting there is a process when where you get the financial data. See here, you get the financial data. Now what you do, you use that financial data, that source data, for recording, and for recording we use journals. After that we use that data for classifying, for that we use ledgers. Then we summarizes that data in the trial balance, and then further we come up with our financial statement, that is balance sheet, profit and loss, fund flow, cash flow, etc, etc. So we are going to learn about these all things. We are going to learn about these all things in details in future. But for now, we are going to know that these all things comes under bookkeeping. So journal, ledgers, and trials comes under bookkeeping, and from there we generate our financial statements. So what we are talking about, to prepare these financial statements you need to know about five terminologies which we have talked about earlier. Key, for these financial statement, for preparation of these financial statements, you got to make these five terms rock solid, these languages of accounting. So let's start this language first. Asset, then liability, then equity, expenses, and revenues. So let's start. What is asset? When I was studying, when I was teaching in the class to my students, I asked them about asset. So they come up with very innovative answers. Some come up with cash, some come up with buildings, some with factory, some with cars, some with machinery. But there were some students, those come up with some other answers like youth, beauty, degree, etc. So what an asset is? So cash is an asset, youth is an asset. So what asset is? Asset is anything which has value. Asset is anything which has value, which contains value. But if we are talking about, if we are learning in accountancy, what asset is all about? In accountancy, asset is anything, any stuff of the company which has value, but these values can be measured. These values can be measured. You can measure cash, You can measure the value of building, you can measure the value of a machinery, but what about the beauty? Beauty is valuable, but it can't be measured. Youth can't be measured, degree can't be measured. So for an organization point of view, for a company's point of view, most importantly for accounting point of view, what asset is? So asset is company's stuff which has value, and where values are reliably and reasonably measured, where values can be reliably and reasonably measured. More importantly, these assets are owned and controlled by the company. Means assets are the company stuffs which has value, and those values can be measured, and these stuffs must be owned or controlled by the organization or company. So this is known as asset. Further addition to the definition of asset, or further to add some more meaning to the assets in the from the accountancy point of view, these assets are created from past transactions, which means in past company has gained, company has received some amount from which they have purchased this asset. Means these assets are created from the past transaction which are going to give you future economic benefits. So asset is a company's stuff which has its own value. Those values can be measured. These stuffs are owned or controlled by the organization, and these assets are created from the past transactions, and they are going to give you future economic benefits. This is asset is all about. To be very simple, to be very precise, assets are the stuff of a companies which has measurable values. That's it. That's it. You have to remember what asset is. In accountancy, the examples of assets are cash, account receivables, inventory, PPE, plant, property, equipments, etc. We are going to uh, read in study in details about this these assets examples in future classes. For timing, you have to just remember asset are companies stuff that has measurable values, and those are owned and controlled by the company, and they are going to give you future economic benefits. That's it. So coming to our second word, that is liability. When I am going to say the word liability, the word which should strike in your mind, that is O. 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 Liability is nothing, it's O. Meaning, liabilities are the obligations. Matlab, liabilities are the obligations which company has to pay back in future. For example, when you use mobile, you have to pay the mobile bill. When you are using the electricity, you have to pay the electricity bill. If you are living in a rented apartment, you have to pay the rent to the landlord. Means you are owing someone something, you are owing something to someone. These are liabilities. These are liabilities. If you have a driver, you have to pay him salary, you have to pay him monthly salary. Matlab, you are owing salary to the driver. This is liability. Means liabilities are nothing, these are present obligations for you, for any company. These are the present obligation. In return to this present obligation, a company has to transfer some economic resource. Means if you are owing someone, you have to pay some economic resource to them as a result of the past event. Matlab, the service or the product have been provided to you earlier. If you are living in a rented apartment, when you live in the apartment for a month, you pay the rent to the landlord. Matlab, for that past event, for that accommodation in the apartment for last 1 month, you have to pay a rent. If you have a driver, he will give you service for the whole month, then you pay him the salary. Means for the past event, for the past service of 1 month, you are going to pay him, you are going to transfer some economic resource to him. This is known as liability. So in simply liability is nothing but it is the owing of something to someone. When you are owe something to someone, this is your liability. That's nothing. And liability are the claim of outsider on the total asset of the company. When you receive, you have a certain amount of money. Suppose I am having certain amount of money, say I am having 1 lakh of rupees. That is my asset. Means I have cash which have certain value. That is 1 lakh. This is my asset. I have a driver. He gave me service for last 1 month, and for that month, that last 1 month, for that service I have to pay him 15,000 of rupees. So this is my present obligation. This 15,000 is my present obligation. I have to pay him. So on my total asset, that 1 lakh of rupees which I have, my total asset, the driver has the claim of 15,000 rupees. So, liabilities are the claim of outsiders on the total asset of the company. So, the examples of the liabilities in with reference to the accountancy, the counterpart of asset. In asset, we have account receivables. Here we have account payables, salary, wages, bank loans, etc., etc. So, like an individual, companies also have to pay something to someone. This is known as liability. So the word for asset, that is values, the values which are measured. Liability, the word is O. For liability, the word is O. So uh, if you have learned till here, I am very confident that you have made these two terms rock solid in your mind. And see, you can see the tear of joy in my eyes. How happy I am to make you learn about these two things, these two languages of accountancy. How happy I am. Jokes apart, let's come up with our third term, that is equity, or sometimes it also called as shareholders equity. To come up with shareholders equity, let's talk about something else. I have a house. I am having a house. This house is worth of rupees 3 crores. So, from the definition of asset, I have something means I have something, I own something. I own something. And it also has a value which can be measured. So, I can say this house is my asset. I can say this house is my asset. Okay? I have a house means I own a house, and that house has a value of 3 crores. Matlab, its value can be measured. So I can say this is an asset for me. But as a counterpart, I also have a loan of 2 crores rupees. I also have a loan of 2 crores of rupees. So I have to pay someone 2 crores rupees. So I can say this is my liability. This is my mortgage. So let's come up with a solution. Let's come up with a free radical solution, a hypothetical solution. If I will sell off my house, I'm not selling off my house. It's a hypothetical situation. If I sell off my house, which has worth rupees 3 crores, if I will sell off my house, I will get 3 crores of rupees. And from 3 crores means I have an asset of 3 crores. And what was the definition of liability? The claim of outsider on your total assets. Yani, from these assets, 2 crores has to be paid to the outsiders. So, if I have an asset of 3 crores and I pay back all my loans, I pay back all my mortgages, liabilities of the outsiders, I'm left with a money of 1 crore. I'm left with a money of 1 crore. This 1 crore is nothing. This 1 crore is known as the equity or shareholders equity. So if I will sell off all my assets and pay off all my liabilities from those assets, the money I'm left with, this is known as equity. Just as simple as that. If you know what asset is, if you know what liability is, you have to do nothing but you have to subtract the liability from asset. The value which you get, this is known as equity. The value you get, this is known as nothing but equity. Just as simple as that. So here we come up with a scoreboard. 3 crores minus 2 crores, that is 1 crore, and this 1 crore is known as the shareholder equity. So if a company sell off all its assets and pays off all its debts, the money the company is left with is known as shareholders equities. Just over. Over. So when we are talking about equity, equity is this. Equity is this. Nothing. Plus equity is this. And if we take liability to this side, this is a simple arithmetic equation. In accountancy, this is known as accounting equation or balance sheet equation, which we are going to study further in the balance sheet part in preparation of financial statement, which we are going to study further. For timing, equity is nothing but it is the deduction of liabilities from the total asset. Over. So this is the theoretical part. Equity is the residual interest in the total asset of an entity after deducting all its liability. Equity is the claim of owners on the total asset. Likewise, liability was the claim of outsider. So equity is the claim of owners on the total asset after paying all the liabilities. The money you are left with, which is known as equity, it is the claim of owner. This money goes to the owner. This is the owner's money. So equity is the claim of owners on the total assets. The the examples of equities are common shares, retained earning. We are going to study further what common share and retained earning is. For timing, you have to just remember what equity is. Equity is asset minus liability, and it is the claim of owner on the total asset. There is another term which is capital. Sometimes we use capital instead of equity. So from where we are using capital, we are using capital if we are talking about sole proprietary, or we are talking about a company which has few partners. But we are taking an example of a company which has thousand lakhs of partners, lakhs of shareholders. That's why I'm using the term equity. But when you are talking about sole proprietary, you can use the word capital. There's nothing difference. So after learning equity, our next term is revenue. That is, revenue means earn, to earn. Asset was value, liability was O, equity was asset minus liability, revenue is earn. What the company is earning, what the company is receiving, what the company is earning from its day-to-day business liability, what the company is generating from its sales of goods and services. Revenue is nothing but it is an inflow of money to the organization. Revenue is the inflow of money to the organization, what the company is earning. Revenue means that someone is owing you some money, means someone is owing you some money. If you are selling them goods or services, they are going to pay you. That is, someone is owing you something in response to your goods and services. This is revenue. So, when we are talking about the word revenue, there's one simple word which you should come in your mind, that is earning. That's it. Oh, that's it. Now, our next language is expenses. What expenses are? Expenses are nothing but costs. Expenses are cost of running an organization. I'm teaching in a college. Let's take this example. I'm teaching in a college. Take so this college has some cost for running its operations, day-to-day operations. AC, air conditioning, the air conditioning bill, the electricity bill, that is utility expenses, the corridor in which we are roaming, the playgrounds, the parking areas, the portico areas, the plantation, these are the maintenance expenses. If something has broken, if something is out of order, the college has to bear some repairing expenses. And most importantly, I'm teaching in the college. I love my job, but in return, I need money. In return, I need to be paid a certain salary so that I can run my daily expenses. So, these is the expenses of a college. So, what we can conclude from here, from this example, to run the college, to run the day-to-day operations of the college, a college has to incur certain costs, certain expenses. So expenses are nothing but it is the cost of operation for an entity, for an organization. So why this cost the organization has to bear? Why this cost the organization must pay? The organization pays this cost to generate the revenue. Here comes the catch. Organization has to bear these costs of operations so that it can generate the revenue, it can generate the cost, the inflow of money inside in the organization. So expenses are nothing but the expenses are the cost of operations that an entity has to incur to generate revenue, but from which no future benefits are expected. Sorry, from which no future benefits are expected. Means if the college is paying me the salary, this salary is paid to me for my services. From this salary they can't expect some other future benefits. I have already given them this service. So how they are going to generate this revenue? They are paying me and they are receiving the fees from the students. So the fees from the students is the cash inflow, that is the revenue for the college, and for which they have to incur, they have to bear certain expenses, that is paying salary to me. This is expenses for an organization. So there is one more scoreboard, that is if you subtract the expenses from the revenue, means if you subtract the cost from the earning of an organization, you will come up with the net income of the organization. Means whatever you have learned, whatever you have earned and whatever you have paid, the money now you are left with, that is known as your net income. That's it. This is income. So what we have done, we have learned here the five languages, the five important elements of the accountancy, that is asset, liabilities, equity, revenue and expenses. Assets are values. Liabilities are what the company owe. Equity is nothing but it is asset minus liability. If we sell off all our asset and pay off all our liabilities, the amount, the money which we are left with, this is known as equity. Revenue is nothing but its earning of an organization, and expenses, the cost which a company has to bear to generate the revenues. So now I am very confident that we have learned the terminologies of accountancy, and we have made this rock solid in our mind. Now we are ready to prepare the financial statements. So if you have watched the video till here, I'm very thankful to you. Thank you so much for watching this video. And if you have learned, if this video is helpful to you, please do like, share, and subscribe my channel on Instagram, YouTube. And if you have certain queries, if you have left with some queries, please you feel free to email or DM or to write in the comment section. We are very delighted. We will be very delighted to solve your queries. You will get the PDF link in the description box. You will get this PDF and you can learn further from this video. For now, I'm just signing off. Thank you. Bye bye. Take care. Hope to see you in the next video.